Well, good morning or good evening, depending on which part of the world you're in. Welcome to this latest quarterly review, and I think the information is going to be pretty interesting because, as we all know, there have been lots of changes that have occurred due to the spectre of rising inflation and that being anchored for some time, and the response from central banks raising the official cash rates around the world, especially in developed nations. So that's had an impact clearly on property markets, and Australia is no exception to that. So we'll go and have a look at some of the impacts that have occurred in the last 3 months. And even though it's a review to the end of June, we always look at the latest data. So some of that is actually in here from just 2 days ago. Disclaimer, firstly, this is all general information, so if anyone needs any personal advice, then please don't hesitate to reach out, email us or call us, and we can get someone to be in touch with you and give you assistance on a personal level. And for people who don't know who we are, just a little bit of background. We first founded the advisory business in 1988, so I have been doing that for quite a long time, and initially that was actually designed to help people like myself, my peers, young doctors. And then that moved into the other professions, legal profession, accounting, and also into the commercial world, so banking, finance mainly, etc. So a lot of those people moved offshore and developed a bit of an expat community. And what we found was that our client base, regardless of whether you're a surgeon or a banker or an executive, they have very similar demographics. Most of our clients are very time poor, they earn higher incomes, and they prefer to get an assistance with virtually all facets in relation to especially property transactions. And most Aussies, or most people, actually like to have property as part of their overall asset portfolio, if you like. But they just didn't have the time to do it properly, do the due diligence and research that's required. So we developed if you like, a bit of an end-to-end concierge service, which is available for our clients to utilise if they so choose to. And we charge $4,950 for that settlement of a property if they decide to. But as you can see there, some of the entities that we have the advisory business, Unicorp Partners. Wise Guru is the international consulting business and specialises in helping Australian expats all around the world. Aussie Loan Guru is our lending business, and again we've developed a bit of a niche, not just for professionals there in Australia, but for Australian expats, and we can give our clients up to 85% LVR, or loan to value ratio mortgages with no mortgage insurance, even if they are earning foreign income. So we find that's a great benefit for most people, and you know, people can choose whichever part, I suppose, they want of this. And the Australian real estate business is Aussie Property Guru. So just a little bit of background, and let's have a look at what we're getting as questions most commonly at the moment. And they relate to inflation. You know, how will inflation affect interest rates? How is it going to affect my property prices? What's going to happen to my rental income? Which areas of Australia should I look at now if I'm going to invest, or if I have investments currently? And how do we navigate all of the interest rate environment and you know, the products that are available currently from various banks and lenders? So most of the questions revolve around that. And if we look at why, I suppose, look at the background of all of this, you know, it does relate to mainly inflation expectations and inflation as it's coming through in both headline inflation and core or mean trimmed inflation. We've got supply bottlenecks, we all know that. Doesn't matter where you travel in the world, it's very difficult for people to find sufficient staff to help them in their businesses. We still have the ongoing COVID-19 situation in China, which is disrupting growth there and hampering that. We still have a war in Ukraine, between Russia and Ukraine, so that's causing lots of ramifications, especially in the Eurozone. And these things are not actually going to go away straight away. So it's something that we need to bear in mind. And from an Australian perspective, the RBA thinks that inflation will peak potentially in the fourth quarter this year, and in the second half also in the US. So two important markets, obviously, from an Aussie-centric viewpoint to look at. If we look at the UK, largest inflation, double-digit inflation just released in 50 years. So a lot of these pressures are going to be ongoing, but how do they impact us as property investors in Australia? And Australia is a very large continent, as we know, a large country with a fairly small population. So research is really important when you're looking at this. And we utilise, obviously, the government bodies, so the MB.BS, Commonwealth agencies in relation to population, CoreLogic, Urbis, Resolution Research, and Oxford Economics, just to name a few. But then you've actually got to put your own practical overlay on that, because there is just so much information that's available these days. So let's have a look at inflation, because everyone's talking about it, and sometimes I think people forget things. I mean, inflation has implications for housing demand and housing prices, but housing itself influences inflation to a large extent. Up to a third of the CPI relates to housing, and inflation is measured by the change in the Consumer Price Index, or CPI, which tracks the cost of a basket of goods and services that are consumed by households, specifically from other sectors like governments or businesses. So, how is housing factored into inflation? I mean, if you look at the red right-hand side, I think everyone knows this, that, the change in rents is factored into it. The cost to build a new dwelling minus the land value, which some people may not know. The cost of renovations, repairs, maintenance, rates and charges, and utility costs. But the interesting thing is the cost of purchasing land is not included in CPI. It's an asset. The cost of purchasing an established dwelling also isn't, because it's treated as an asset housing. And the cost of servicing a mortgage was removed back in 1998 when the RBA started using monetary policy to target this, in fact. So some interesting things there, and I thought that would be good background for most people to know. The real question that we get is, with interest rates, clients always ask us, how far do you think they'll go up and how fast will they rise? Well, one of the questions already been answered. In fact, surprised some of us, the speed of increases that central banks are now bringing into bear in their monetary policy agenda, and that's probably due to the speed and massive decline that happened during the pandemic. But, the RBA's most recent raise was 50 basis points again, and brought the official cash rate to 1.85%. And I anticipate that in September, at the next meeting, they'll raise the OCR by another 50 basis points to 2.35. And then it'll be an interesting situation whether they raise by 25 points or 50 basis points the following meeting. I think really the RBA needs to look at how the data comes in, because the effects of raising interest rates is a lagging situation. So we find that, generally speaking, the banks and lenders will pass on the increase, but that will take some time, perhaps up to a month to filter, and then perhaps another month to actually impact borrowers' cash bottom line. So I think we'll start feeling the impacts of these rate increases over the ensuing 2 to 3 months, more so than we have at this point in time, as that filters through, and hopefully it impacts consumer behaviour, especially consumer spending, because consumer confidence has come off and fallen off a bit of a cliff, as we've seen in all of the research. But consumer spending has held up quite strongly, and that's a challenge for the RBA and other central banks around the world where that's the case. So it'll be interesting to see what happens. Australia does have a very large level of household debt, so it should be more sensitive to increases in the official cash rate as they get passed through to variable interest rates. But the one thing that we need to remember is that many clients of ours, certainly, and many people in general, are still on very low fixed interest rate loans, and they're not going to come off for another potentially anywhere between 12 months and 4.5 years. So something to bear in mind. And if you have one, you should be quite happy. So, interest rates are set to normalise, and I put that in inverted commas because, perhaps we've now gone to a restrictive setting, certainly after next month, but it is normalising things, and most people that have been in the markets for many years recognise the fact that we've been very fortunate to go through an extraordinary period of ultra low interest rates. And especially ultra low fixed interest rates for, say, 2-3 year periods, as that was brought in to enable the economy to expand out of the pandemic induced slowdown. So if you have a look at the graph there on the right, the 30-day interbank cash rate futures, that's what the markets were indicating at the beginning of July, so end of June. But if you have a look at how this moves around, it's important to keep things in context, because here you go on the left-hand side, you've got 3rd of June, markets are anticipating the rate peaks at about 3.6% during mid next year. Then if you look at this here, 2nd of August, you go down to 3.2%, and currently it's back up to 3.6%. So these are not a thing, these measures are not something to panic. They move around on a daily basis, as we see with bond yields. I mean, bonds have been extremely volatile this year, and I think it's something that we just need to keep an eye on, look at the data, as I say, and I think the Reserve Bank will do that. We'll look at the data to see how they manage the official cash rate settings going forward over the course of 2022 and into early next year. The other thing that's interesting, and we'll look at this more on perhaps some of the macro global side of investment via equities and bonds, and concerns are escalating now from inflation to recession. So obviously that's not good from a general economic viewpoint, but certainly if you are a borrower and you're feeling stressed about the increase in interest rates, it's something to keep an eye on, because if we get to the situation where recession is looming, and I think it is in the US, then clearly central banks may not be talking about this now, but will look to potentially reduce interest rates, and the financial markets are factoring that in, say in the second half of next year or 2024, depending on where you're looking. So something to keep an eye on. These are just some markers that we can look at, because people are always asking, where is the interest rate going to end up? So if we look at financial markets and they're saying 3.6%, then that's going to be around 6% for a mortgage rate that retail borrowers will end up paying. And as we can see, working our way down from there, potentially rates will settle somewhere between 5 and 6%, and that will take a little bit of time to play out. But it gives someone an idea of what may be in store for us. And this will change. This is the latest information from Westpac, Bill Evans' presentation. And if we look at some of the macro features there, they're expecting GDP at the end of this year to be 4.4%. And as you can see, massive slowdown next year, 1%, and then 2% in 2024. Unemployment getting down to an incredibly low 3%. It's heading that way now. But then blowing up to 4.2% next year and 5% in 2024. So again, looking at some of this economic slowdown, I'm sort of more bullish about the Australian economy. I don't think potentially it has to follow the US or others into recession. But again, we'll see what happens there. Look at headline inflation. Westpac's prediction is that it'll peak at 7.6% later this year, and then drop substantially to 3.1% next year and 2.7% in 2024. And one of the things underpinning their forecast there is that oil prices will come down substantially. So energy costs will come down and assist with that. And we've already seen that. I mean, oil's been trading at above $120 a barrel for a long time, down to the 80s or low 90s at the moment. Their forecast for Australian dwelling prices, minus 4% this year, minus 10% next year, and 2% rise as markets stabilise going into 2024. Credit growth again, still very strong, but then coming off quite strongly next year. Wages growth, still pretty anemic, 3.25% at the end of this year, 3.9% next year, 3.6% the year after. So that could help people to deal with the increased costs that they're going to face due to interest rates on their mortgage payments. And the cash rate that Westpac is forecasting is 3.1% at the end of this year, and then peaking at 3.35% in the early part of 23. But interestingly, have a look there, then they're predicting a reduction of 100 basis points in 2024 to 2.35%. And Aussie US dollar exchange rate, 73 cents the end of this year, 78 next year, and then 80, which is interesting. I mean, I've been fairly bullish on the Australian dollar due to where commodity prices have been, but and in the last quarter we sort of went to a more neutral position there, and basically have a bet each way with the US dollar and the Aussie dollar, because if these recessionary fears come through, then there is generally a flight to safety, and the US dollar benefits from that. So if we look at that in slightly more detail, here you can see the latest cash rate, 1.85. Westpac thinks they're going to go up 50 basis points, as do we, next month. And I'm not sure whether we'll see 3.1% by the end of this year. I think it may be less than that, but time will tell. And it will potentially get to this level, I believe, in 2023, simply to try and quash these inflation expectations that may be becoming embedded, and that's something that Reserve banks certainly want to avoid. If you look at the different swap rates there, but look at the 10-year bond rate, it's about 3.36 at the moment, and I think we'll track down as we go through next year. So it'll be interesting to see, how bond funds go in terms of duration. Aussie dollar we've covered. So the other important thing is population and population growth, or lack of population growth. And this is the latest from the Commonwealth in terms of what they anticipate is going to happen. And I look at that, and again, we have the overlay of our own data and looking at what things are happening on the ground. So there's been a massive rebound, as you can see there, the green line, in terms of what's happening with the Australian population after the borders have opened, and the Commonwealth thinks that population is going to return to about 1.4% per annum after 2024, which is a very high rate of immigration for a developed nation. But Australia isn't your typical developed nation. We have a large land mass, small population. I think it's a very desirable place for people from overseas to wish to migrate to or come and work in and later retire. So I think that will continue, and certainly you only need to speak to anyone in business in Australia for them to tell you that we do need a lot more skilled and unskilled labour. So we need more people to come in. And as you can see there, since the borders have reopened mid-December, there have been more than 130,000 international student arrivals in Australia. Still a long way shy of where it was, but it's pretty good, and it's important. And that will obviously then feed through to housing demand. Most temporary visitors obviously will rent something, so we've got to look at it and be a bit more granular where that demand's going to go. But the overseas arrival figures have surprised greatly to the upside, and all you have to do is do a lot of travel, as we do, and you'll see that planes going into Australia are always full. And I remember the period in February where it was full of students, a lot of them from Southeast Asia, from India. So that's a good thing, and I think will continue. So you have a look at this here now. There've been over 11,000 people a day coming in, and the numbers have been revised up by 82,000 people from what was predicted for the 21-22 year in terms of net overseas migration. You can see this here as the borders open to everyone, the pale grey line, short-term visitors went right up, but you can see here the green line, the bump in overseas students, etc. And you can just see that sense of movement. That's really going to continue to grow, and I'll be interested to see the next quarterly set of figures, because I think that's going to continue. If you look at this, this is from 2 days ago, have a look at this trend. This is for short-term visitor arrivals, and interestingly enough, 21% of those were New Zealanders. It's one of the, I guess, quirks, I suppose, if you look at the New Zealand economy and the Australian economy. They're ahead of us and everyone else in terms of the central bank raising interest rates. They just moved to 3% earlier this week. But they have another issue. So there, a lot of younger people are actually leaving New Zealand, leaving the economy and the workforce there and coming to Australia. So Australia's getting a benefit, but New Zealand isn't. Then if you have a look at, and this is again important because Australia is so large, state and territory populations and interstate migration, because that's again going to impact housing demand, housing prices, vacancy rates, rental factors, etc. So if you look at it here, you can see that Queensland has been the standout, I suppose, during the pandemic. It was actually already prior to the pandemic, and certainly that's escalated massively last year, forecast for this year and next year. We're seeing continuing and ongoing migration, particularly from Sydney, also from Melbourne into southeast Queensland. We see that with our own client base, people selling or not selling, but moving themselves and their families north, where they're getting, potentially a better value equation and a better lifestyle and at a lesser cost. So the other thing we look at is lending, financing demand for property purchases. That fell for nearly 4.5% in June, but it's been moving up and down. The major thing there is if you look at first home buyer lending, it went down by 10% for the month. And I think that's an area that's going to be massively impacted, I suppose, as we see this tightening monetary policy and official cash rates moving up, and that's getting passed through to the marketplace. I think that cohort is going to be the most affected one by this. If we see there on the right, investor lending is slightly below its long-term average, but still around that level. So it's more owner-occupiers, and again, that's probably swayed more by the first home buyer market. The other thing that we also obviously consider is, are regulators going to take any action? And I certainly don't think so at this point in time, because when you look at what's termed to be a riskier loan, so a high LVR, loan to value ratio, interest only loans, high debt to income levels, etc., they really seem to be, I think, fairly benign, diminishing. So I think, if anything, the regulator needs to potentially look at what are they going to do in terms of the prescribed buffer that they make banks utilise when looking at people's servicing capacity, and I'll come back to that later. So, let's look at property as an asset class. It's certainly residential property is the largest asset class in Australia. And if we look at what's happening to national home values, they declined this quarter, but we need to be far more granular than that, because that's just a headline number. And nationally it was down 2%, and if you look at it over an annual basis, home values are up 8%. But all the various capital cities are now either in decline or heading towards there. So worth having a look at this, state by state. And obviously there are more than just the capital city property markets, there are all the major regional markets and so on. But if you have a look here, Sydney is now down 4.7% from its peak, Melbourne 3.2%, Brisbane's just flatlining, Adelaide has been one of the strongest, and if you look at it over here, Darwin and Perth still above the negative impact line, but it's all heading in the same way. And then if you try and impose greater granularity into assessing this data, if you look at the top 25%, the most expensive percentile, that's had the biggest declines, as you can see there in Sydney and Melbourne, and starting to decline in Brisbane and Hobart and Canberra. In Adelaide, as you can see, all segments were still recording a rise over the quarter, as they were in Perth, albeit far smaller. So that's why I'm saying, when you look at headline numbers or when you read news articles, you really need to do a lot more research to figure out what that impact is going to be in whatever part of the country you're in. So clearly, as with any asset, supply and demand is a really important driver, both of pricing and many other factors. So over June, if you have a look at the total number of new dwellings that were approved, 16,500, that's down from the previous month, but more importantly, it's nearly 5% below the decade average, and that's generally due to lower medium density housing approval, so apartments, units. And the issue here, I think, is that we're going to have further constraints because, as most people would know, building costs have escalated substantially, labour costs have escalated substantially, and simply builders can't get enough people to complete projects or to construct them. So I think we're going to see some further construction headwinds, projects that have been sold not being built, others being pulled. So that's going to add some more supply bottlenecks, and I think it's something we need to keep an eye on because it's playing out already. If you look at rental yields, they rose to 3.41% in July. So you can see the shape of that curve is escalating. The yield in Sydney and Melbourne is still low, as it always has been, but the other capitals are moving higher, and I think that's going to move higher overall through the second half of this year and into next year. So unit rents have shown a really solid rebound in recent months, and the pace of growth is picking up there just about everywhere, by the way, as renting homes or freestanding houses becomes even more expensive. So if you look at that increase, it's been sharp, it's been strong, and we're seeing that again looking at our own database and the amount of rental increases coming through, and the size of those is increasing all the time. As you can see there, unit rents and housing rents similar in some areas but quite different in others. So how do we use all the research? What do we do with the data? Because there is so much of it around, as I'm saying. I mean, you could just look at data and statistics the whole time and end up being very confused in relation to what you think you should be doing. As I said earlier, residential real estate is the largest asset class in Australia, as we can see there. It's nearly $10 trillion. And I think the interesting thing there is, because I often speak to people and they all think that everyone's in the same position that they are. So let's say someone's bought an expensive home in the last couple of years, paid whatever, $6, $7, $8 million for it and borrowed up to 80%, and they think everyone's in the same position. But that's actually not the case, because if you have a look here, the outstanding mortgage debt on that 9.8 trillion is only 2.1. So about 23% leverage. In fact, a lot of people in Australia own their homes. They're totally unlevered. And that's something that everyone needs to consider when they think about what may happen in the ensuing, say, 12 months. And I'll come to some of the finer ramifications of that. So if we look at past cycles, peak to trough, the declines have generally been a bit deeper since 2005. The last one was down 8.3%, so that's 2017 to 19 or 20, depending which way you look at that. And that was, that was artificially induced by APRA and the regulators coming in, stymieing credit growth. If we have a look at what happened to housing prices during prior periods of increasing interest rates, again, it's a fairly interesting outcome because it's not one that you would think of when you first look at it, because rising interest rates are generally a headwind for house price values. And I think that will be potentially shown to be sharper in this cycle than it has been before, because again, we're coming from a very, very low level of interest rate costs just going through the pandemic to now going through this tightening cycle. If you have a look at this though, I think that's going to be a really important issue, and that's, if you like, the level of transactions. So if you look at that, the national level of listings is rising gradually, as you can see that dark line, but it's well below the average for this time of year, and it's nearly 25% below the 5-year average. So, look at it pragmatically. If you own a property and you don't have to sell it, then you probably aren't going to. So you withdraw it from the market because you're not going to get the price that you think you want for it. And many people are in that position. So I think, these statistics are really important because people are going to say, well, we're not going to market our property. We'll wait. We'll wait through the cycle. And I think you'll see a lot of that going on. So, if people think that, they're buying, widgets where, McDonald's burger, where everything's the same and the price of that's going to come down. It's not like that in property, because you have all different properties, different qualities, depending on where they are. You may just not be able to buy them. And that's something to bear in mind. So let's have a look at what happens during these scenarios of downturn, because property, like any growth asset, is cyclical. And if you look at this, let's see, what would a 10% decline in values actually look like? And if you look at this, 10% decline in Melbourne would bring it back down to levels seen in June, July 2017. Whereas a 10% drop in Brisbane only takes you back to where we were at the end of last year, so 7 months ago. And as you can see here, I've gone through the various cities. Sydney back to June last year, but look at Perth. If you had a 10% fall there, you'd be back to September 2006 levels. So, again, it really shows that you've got to do your research in Australia, because it's so varied. And that's, an important factor. So it depends on, if you're going to be a property investor, where are you going to look to invest? If you're a property owner, what are you going to do with the current properties that you have in your portfolio or that you live in? And as we know, people often say to me, oh, look, what's happening in the Aussie property market? And as I say, well, there's no such thing. That's just something that news media talks about or people talk about, because what's happening in Sydney or Perth or Darwin or Brisbane or Melbourne right now is totally different, and depends a lot on what's happening in the state economy and many other factors. So this is the latest from ANZ, again, just 2 days old. They expect prices to fall 18% from peak to trough before a 5% rise in 2024. I think the important thing to look at there, if you look at that graph, is the trajectory of that. And it's very similar if we look at other growth assets, whether that be equities in Australia or internationally and so forth. And you'll see they are cyclical and they move up and down, but ultimately, the movement is up. So that's why it's important, as I always say to people, if you're buying things, make sure that you can afford to keep them long term. And with property assets, generally people utilise leverage to a large extent. So it's important to then consider what type of yield you're getting on that asset, on that property. It's a bit like, how much dividend do you get on the shares that you purchase in particular businesses, in particular companies. So yeah, we look at all of that. I think it's super important because people need to keep these assets longer term to get the full advantage from that. And if you have a look at this on a sort of slightly more granular basis, this is what ANZ came out with again 2 days ago in relation to what they see happening in the various capital city markets and nationally. So the dark blue line is this year, and as you can see, they're forecasting the major decline in Sydney, followed by Melbourne. We've said that, you know, right from the beginning of this upward trend in interest rates. They see increases still this year in Brisbane and Adelaide and Perth. And I think that will actually play through. It may even be a little larger, I think, than ANZ's predicting, and then a decline in those markets. But if you look at overall, and I'll come back to where I think the strength lies and where the weakness lies. So we always have a look at this and we say it's as easy as pie. It's about population growth, infrastructure growth, and employment growth. And if you have those three fundamentals in place, where you're going to buy an investment property, you should generally end up with a pretty good outcome. And again, this varies from state to state and between various city and regional markets. So we'll go into this in a bit of detail. I might just take a quick break for everyone here, and we'll be right back. Okay, if we have a look at the situation in more granularity. So if we go some of the major state capital city markets, if we look at Sydney, it's obviously been the strongest market. I guess has the most. New South Wales has the most diversified economy, but it also has the highest downside risks at the moment due to affordability, and also due to lending. We'll come to that in a little bit later in the presentation. There's an ongoing demand for quality properties in Sydney, and it always has been, but this is now the second quarterly decline in prices. So if you look at the numbers, Sydney came off 2.2% in July. It's off 4.7% over the quarter, and as you can see, it's 5.2% below the record high that was achieved here in January of this year. So the trend there, as you can see, on an annualized basis and on a quarterly basis, is trending down. Then if we look at Victoria, Melbourne, the issues there have been different. There's still negative population growth. Melbourne was impacted fairly badly when the pandemic arrived and overseas students left to go back to their home countries. So slightly different, and the lockdowns that happened in Victoria. So again, specific to that state and that city. It's now the cheapest capital in Australia to rent in, which is amazing. And the pace of declines, I'm just noticing, is starting to slow, and we're getting a return of overseas students. So I think, you know, Melbourne could look to stabilise going forward over the second half of this year, but it'll still probably come down second most to Sydney. So if you look at the numbers, again, if you look at that, you know, annualised and quarterly trend, July came up 1.5%, 3.2% for the quarter, and it's 3.4% below its record high set in February of this year. Now Perth is quite different. So Western Australia, commodities employment strength has been ongoing. In fact, I was looking at some latest data from the ABS and ATO, and two of the highest earning postcodes in Australia in the latest data actually in Perth, Peppermint Grove and Cottesloe. So very low vacancy rates, but we see very low vacancy rates in most markets in Australia now. Price growth is still there but easing, and the lack of diversification in the WA economy is actually a benefit for it, for housing demand and for economic output in general. So if you look at that there, you can see Perth is still positive on an annualised basis. It's up 5.5%. Quarterly decline is still positive as well, and that's the important one, even though it's not a lot, it's 1.2%. But you can see, I think the trend is going to become similar to the other capital city markets. And Perth dwellings are currently at a record high. So the previous high was set 8 years ago, 2007, and it's something we need to look at when we look at where we see markets going forward. So then, in a more general basis, like people ask us this question often, should I buy a new property or an old property? And of course, there's no correct answer to that. You can buy either. For our client base, because as I said initially, they're generally very time poor, and they need someone to give them assistance with managing these assets. They don't want to be actively involved in that if they can possibly help it. So new tends to be better, especially if you're buying high quality new dwellings as an asset, because there shouldn't be any maintenance issues or repair issues. It's easier to attract high quality tenants and to keep them in the property. But let's say you have experience in the construction business and you're retired or nearing retirement. You may choose to buy an old property and seek to add some value to that. But I think it's important to recognise that you need the time and skill set to be able to do that, because if you speak to anyone now who's trying to do a renovation in Australia or build something, it's just so hard to try and find skilled labour to actually assist you with that project, and the costs keep going up, not to mention the input costs of the materials that you're going to utilise. The other big benefit in Australia, of course, is our taxation system. So we have the added overlay of being able to claim non-cash tax deductions against other Australian taxable income in the case of Australian expats, or against personal exertion income for people living and working in Australia. And that's really quite important. So Division 40 and Division 43 enable us to deduct usually quite substantial amounts from our taxable income, especially if they're high quality properties and have high value inputs. So they're all things that we can go through in more detail for people if they choose to reach out and find some information about that. So let's have a look at what we think might be some well-positioned regions at the moment. Let's see what this data is telling us. Remember, it's as easy as pie, but don't forget, the fundamentals. And I think this is a great time for people to recognise that as we see the cycle swing downwards. That's when it's important to recognise the fundamentals, and it should give you an opportunity to be able to add to a portfolio in a meaningful manner. So what the numbers have been telling us for quite some time is that southeast Queensland, Brisbane, giving the best, if you like, value equation. Queensland has a diversified economy, even though most people think it's a mining state. That's not the case. What the COVID pandemic has shown us is that people like the work from home lifestyle, and many large employers now are continuing to allow their workforce to work from home or do so on a hybrid basis. So you've got the lifestyle element, particularly in the coastal regions, but also in Brisbane, appealing to people moving, especially from the southern states, from New South Wales and Victoria. And what's happened is that the value gap that existed before the pandemic, and this interstate migration began then, is there now, and on a nominal basis it's even larger. So say you had a property that was worth $2 million in Sydney and $1 million in Brisbane. It may now be worth $3 million in Sydney and $1.5 million in Brisbane. So whilst the percentage of the value gap remains the same, the actual nominal value has increased because it's now $1.5 million instead of $1. So something to bear in mind. And it's had the strongest interstate migration over 15 years, and every quarterly set of numbers that I look at that increasing, and I think that'll continue for quite some time. So if you have a look at it again on a more quantitative basis, as you can see there on an annual basis, it's just turned over. So Brisbane's up 22% annually, but was down 0.8% in July, and it was positive but just marginally so for the quarter. So Brisbane's now 0.8% below its high water mark, as we can see that was obtained last month. So if we look at that population growth, Australia's internal population growth, so interstate migration, you can see Queensland, where is it there? Queensland, is really setting the scene for this. 1.4% change over the prior year, so much larger than the other states. and Victoria is still suffering, as I say, some of that outflow. I think that will normalise in Victoria over the ensuing quarters, but it'll take a little bit of time, and I think Queensland will continue with this ongoing population growth that we've been seeing for quite some time now. So if you look at the components of that, net interstate migration, very important for Queensland, as you can see the dark blue bar, coming mainly from New South Wales and Victoria, and the other state to pick up some of that is Western Australia. So if you look at net overseas migration, more important for Sydney and Melbourne as overseas students return. So we'll look at these numbers. I'll be keen to see the next set of quarterly numbers and see how that's going, but that may take another 3 quarters to play out, so the beginning of 2023. And then if you look at some macro factors, this is something that really has arisen more recently since Brisbane won the 2032 Olympic bid. A lot of infrastructure projects were already begun there long before this, and are well sort of down the path of their development. But this will, I think, continue with those tailwinds where more infrastructure is going to be built. There's a long runway for a lot of these, obviously. There'll be more employment opportunities, both short and longer term, and also from an international visitor and granularity viewpoint. Brisbane will become more apparent to people around the world than it has been. So I think there are some other benefits, and I can go through those in far greater detail, but I think it's more to recognise where those tailwinds are going to play out. Some of them may be even more targeted in terms of geographics in certain areas within Brisbane or the surrounds, and we can go through all of that in detail with clients if they need to have a bit more information surrounding those factors. So if you look at some of those infrastructure projects, one of the standout ones I think is Brisbane Airport, that was completed last year. The parallel runway there was completed, creating tens of thousands of jobs, but more importantly giving that airport the throughput of Changi Airport in Singapore or Hong Kong. Clearly that wasn't very relevant last year when it was still in the throes of lockdowns, but now is, and I think that's going to contribute large amounts to the state economy and to what's occurring in southeast Queensland, and that'll be ongoing. If you look at other major infrastructure projects, the cross-city rail, the entertainment centre, the casino, there's a lot happening in Brisbane, and all you need to do is go and travel there to see that actually occurring on the ground as we do. So, what's the value proposition? Turn the lights on. But it's really about helping people not make some of the common mistakes that we see, on an ongoing basis. It's quite frustrating because if you look there's no lack of information available, research. You just have to go onto Google and have a look, and you can spend weeks and months poring over that. But it's buying into a strong market of the future, because people tend to buy into things as they're peaking. It's just human nature, and that's why I'm saying the research and guidance can be really important. But the other thing is this thing, waiting too long to invest. I mean, you can research things forever, but if you don't do anything, nothing's actually going to happen. So when you're doing all that, be aware that any investment won't do. We often get this, especially with Australian expats, wanting to do something for a long time, and all of a sudden they're saying, well, now I'm ready, look, just give me something. Don't do that. You shouldn't ignore your point of difference. It's really important for future capital growth, for income, for rentability, many things. So, have a look at this. If you're going to buy some investment grade, compromised, small apartment that may have a bad floor plate, and you're buying it in a building with 1,000 apartments and 600 of them are exactly the same, it doesn't give you a great deal of point of difference. There's no uniqueness. So when you go to rent it, you'll be competing with everyone else there, and when you eventually want to sell it, the same thing will happen. Doesn't matter whether that's in Melbourne or Surfers or wherever. And the other thing is, don't try and be seduced by really high rental yields in areas that may rely on a single sort of commodity to drive the local economy. I picked out Port Hedland, but it can be anywhere, but it's often mining driven. So those things are highly volatile and can cause some really bad outcomes for people in the longer term. Because as I said, if you're going to buy real estate, you've got to make sure that you can afford to hold that long term. That's how you're going to get the best benefit from this. So if we look at things then in terms of more granularity, I'm looking at Brisbane here, and look at supply and demand. You know, the average annual demand prior to COVID was, for the 4-year period before that, was 5,300 odd dwellings to be produced on an annual basis. Have a look at what's happening now, and this is what I'm saying. There are large headwinds there due to supply chain constraints, both from materials and from labour shortages, and that's going to play out, and this will obviously impact then the rental market in the greatest manner, but it will also impact housing prices for those sort of dwellings in general. So we look at the sort of things that owner-occupiers would like to live in, and I'll come to that in a minute. But if you have a look at the distribution between various regions of the city, as we do in different suburbs, you can see it's also quite different in relation to what's happening at that level. So you look at different levels within different marketplaces to give you a better indication. And this is a survey ANZ did earlier in the year, and it's showing what people want in terms of lifestyle experience of their homes. The pandemic certainly contributed to this. People would like larger areas. If they're working from home, they certainly would like to have a multi-purpose room, some area where they can hide themselves away and focus and concentrate. Larger, oversized apartments, if you're going to live in an apartment, we find are far more desirable. We always tell our clients, if they can, look for a 3-bedroom or 3-bedroom plus MPR style of dwelling. Regional dwelling, we've also seen that in our client base, has become far more popular, but that's swinging back a little now, so I think it'll remain, but won't be as strong as before. And people still want, obviously the amenity that's close to them in relation to entertainment, healthcare, transport, schooling, etc. So if you look at all of those things, what do you need? As I said, the easiest pie, strong economic activity that's going to continue or grow, infrastructure growth, and also existing infrastructure, employment growth, because that drives everything from an economic viewpoint. But you need those unique attributes for your property, and you want to make sure that's sustainable into the future. So let's have a look at, this is just an example of the things that we look for. If you're looking at apartments, we look at the boutique style buildings that are built more for owner occupiers in high quality suburbs, and we like that sort of inner to middle ring, 3 to 13 kilometres from, say, a capital city CBD. The luxury townhomes, again, these are pretty hard to find in that sort of inner middle ring, but that's something that people look for and it appeals to them. And I think that's something that's going to continue because, again, it's in very short supply, it's in high demand. So that'll continue. Make sure you do go with quality builders, obviously. Architecturally designed homes in that region, again, very difficult, certainly at the moment, but always has been, because they're far higher in cost, if you like, so not many builders will attempt that. But we're looking for this style of dwelling for our client base on an ongoing basis. This is something if you work from home lifestyle markets, the Sunshine Coast in Queensland has been a very strong market and will continue to be so. This is an example of the style of building that we like to find when we're looking at, say, capital city markets, high levels of amenity, rooftop breakout areas, concierge, etc. The Gold Coast, again, an area that's seen very strong growth and continues to be really robust, especially in both factors, rental and capital growth. And then I guess most importantly, we look at things quantitatively. So, we can look through, and if someone's looking at a particular property, we can look at what are the costs going to be, both in terms of acquisition costs and then ongoing costs of ownership. And, let's look at what that could look like longer term so that people can say, well, rather than saying, I hope this goes well, they've got a bit of a better understanding, a bit more information to make a more informed choice about these things. So if you look at things in the long term, and this is from an Australian resident or taxpayer's viewpoint, this is what it's looked like in the past. So, who pays for things in the first year? Generally, the U part has been around 6%, the tax office about 21%, and the tenant about 73%. And that's obviously if you're on Australian domestic income tax rates. So if you're a non-resident, if you're an Australian expat, it's different because most people don't have personal exertion income there, so their only form of Australian taxable income will be the rental income they receive. And as I often speak to people, if you structure that properly with the right style of properties, you can build up a portfolio of generally up to 5 or more properties before you actually have to pay any Australian tax on that income. And that's utilising those Division 40 and Division 43 non-cash tax deductions, along with all of your other legitimate expenses that you incur in producing that income. So, for an expat, it looks like this at the moment. You're paying about 12%, and the tenant's paying about 88%. And then we have the benefit, if you repatriate to Australia, you can utilise those saved up tax credits against your personal exertion income there, or if you're not going to go back, you can use it if you're going to potentially sell a property in the future. Speaking of which, this is something that's important because it's something I speak to people about, are you investing or are you speculating? Because if you're buying property, there are higher costs to purchase that and to sell it. So it's really a very good investment medium. It's not a great speculation medium. And interestingly enough, all of the data and all the statistics show that it works really well that way. So if you look at this here, this is the latest figures from September last year, but the median hold period of resales across Australia was 8.8 years. So the median initial purchase price date was around December 2012, and over that period, national dwelling values went up by over 62%. But if you have a look at this, most people actually sell between 2 and 8 years of buying something, whereas if you keep it for say 20 years plus, you can see the nominal growth in the value of your asset really scales up. So if you spend the work up front, do the research, buy a high quality asset in a sought after area that is somewhere that has high population growth, infrastructure growth and employment growth, all you need to do is keep that and maintain it, which should be pretty straightforward, rather than having to spin your wheels the whole time and try and buy something at a low and sell it at a high, because most people get that wrong. And that's the case for most asset classes, not just property. But if you look at that, you can see if you do things correctly, you will be rewarded quite handsomely for that. So, I guess what is our point of difference? I've been doing this for 30 plus years, nearly 35. We've helped many clients. We specialise in certain demographics, professionals, medical, legal, etc. in Australia, higher income earning demographics, and also in Australian expats now, whether they be in Asia, in Europe, UK or America, it doesn't matter. But we can assist people with I think extra points of difference, as I said, from a lending viewpoint, certainly, from a research viewpoint, and from an experience viewpoint. So we go through a process in terms of assisting people with their property investments. But as I said initially, people have a choice of which business they wish to interact with or where they need some assistance. It can be across the board or it can be specific. And we can determine that or assist people with that as we go through that initial scoping phase. If people need some help with any of this, need some personal advice, you'll be receiving a feedback form, please, if you don't mind, fill that out and let us know. We can cover any topics that you may wish us to look at. If you have any particular personal questions, then we'll certainly get someone to arrange a Zoom meeting and we can discuss those with you. If you find us of interest and like what you've been seeing, then please subscribe to our YouTube channel and click like. And we also do weekly Q&A sessions. I do those on video, so if people send in questions, we'll pick something that's topical from that and cover that off on a weekly basis. Again, we save those on YouTube so you can look to see those and go through them. So look, if you want to stay informed, you can also click onto our LinkedIn profile. We do post on anything that's relevant, particularly for Australian expats around the world as things happen and change, both from a legislative viewpoint and other, say, regulatory environment viewpoint. And I will look forward to seeing you all at the next quarterly review. I'm sure that's going to be pretty interesting as we see, some major changes coming through, at least in the next 3 or 4 quarters, the second half of this year, first half of 2023.